Here's the paradox nobody talks about. You've been told your entire life that FDIC insurance makes your bank deposits safe. Yet the FDIC fund holds $128 billion, while total U.S. bank deposits are $18.5 trillion. That's 0.7% coverage. Less than 1%. This isn't about bank runs or conspiracy theories. This is about a specific legal mechanism buried in Dodd-Frank called bail-in authority, the power to convert your deposits into stock of a failing bank without your consent. Most people focus on whether their bank is safe. They're asking the wrong question entirely. To understand why your deposits are at risk, we need to start with what happened on a Friday night in Cyprus, when an entire nation woke up to find their savings had vanished into worthless paper. Nikos Anastasiou still remembers the exact moment he understood. He was 68 years old, a retired shipping company accountant, sitting in his Nicosia apartment on a Saturday morning in March 2013. The television was playing in the background. His wife was making coffee. And then the news anchor said something that made him drop his newspaper. All bank accounts over $100,000 would be subject to a stability levy. The banks were closed. ATMs were shut off. No withdrawals, no transfers. Effective immediately. Nikos had $247,000 in Bank of Cyprus. His entire life savings. 43 years of work. His retirement. His grandchildren's inheritance. He turned to his wife. Her face had gone pale. Neither of them spoke. They wouldn't speak much for the next 2 weeks, because for 2 weeks every bank in Cyprus remained closed. Nikos couldn't access a single euro. He couldn't pay his electric bill. He couldn't buy groceries without borrowing cash from neighbors. He was 68 years old, had done everything right his entire life, and was now standing in line at a neighbor's door asking for money to buy bread. When the banks finally reopened, Nikos learned the real number. Not a stability levy, a bail-in. 47.5% of his deposits above $100,000 had been converted into shares of Bank of Cyprus. If you visualize his bank statement from that morning, the one he printed and still keeps in a drawer, you would see $147,000 vanished, replaced by equity shares in a collapsing institution. Those shares lost another 70% of their value over the following months. Nikos didn't lose 47.5%. He lost closer to 85% of his life savings. And it was completely legal. Now, here's the number that should make you pause. The same legal framework that destroyed Nikos Anastasiou exists in the United States right now. It's called Title II of the Dodd-Frank Act. It grants the FDIC something called Orderly Liquidation Authority. That's the official name. What it actually means is bail-in authority, the legal power to seize your deposits and convert them into bank stock during a crisis. What most people get wrong about FDIC insurance is fundamental. They believe it's a guarantee. It's not. It's a promise backed by a fund that cannot mathematically cover a systemic crisis. The FDIC has $128 billion. Total insured deposits exceed $10 trillion. If more than 1.2% of insured deposits are at risk simultaneously, the fund is empty. And right now, 186 regional banks are sitting on commercial real estate loans that have lost 30 to 40% of their value. Let me ask you a question that should unsettle you. If your bank failed tomorrow and the FDIC fund was depleted, what exactly do you think happens to your money? The answer is not, the government prints more. The answer is Title II. The answer is bail-in. The answer is your cash becoming worthless shares. Maria Santos still remembers standing in her kitchen in Limassol, Cyprus, the morning the banks reopened. She was 44, owned a small restaurant, and had $180,000 in her business account, 3 months of operating expenses payroll for 12 employees' deposits she'd collected from catering contracts. When she logged into her account that morning, $80,000 was gone, converted to shares. Her hands were shaking so badly she couldn't hold her phone. She called her accountant. He didn't answer. She called her bank. Busy signal for 6 hours. Within 2 months, Maria's restaurant closed. She couldn't make payroll. Her employees, people she'd worked with for a decade, had to find other jobs. The catering contracts she'd already collected deposits for. She owed that money back. But it was gone. Converted into stock certificates that were worth less than the paper they were printed on. Now contrast Maria with someone who understood the system. Andreas Kyriakides was 52 in 2013, a commercial real estate developer in Nicosia. Unlike most Cypriots, Andreas had been watching the Greek debt crisis closely. He understood that Cypriot banks were overexposed to Greek bonds. 6 months before the bail-in, he moved 80% of his liquid assets out of Cypriot banks into Swiss accounts, British property, and German government bonds. When the bail-in hit, Andreas lost less than $30,000. His net worth actually increased over the following year as he bought distressed Cypriot real estate from desperate sellers at 40 cents on the dollar. Same crisis, same timeline, opposite outcomes. The difference wasn't luck. The difference was understanding the mechanism before the trap closed. Here's the second question that should disturb you. If wealthy, informed depositors in Cyprus knew to move their money before the bail-in, why didn't anyone warn the regular people? Why didn't Nikos Anastasiou get a phone call? Why didn't Maria Santos receive an email? The answer is simple and ugly. They're not supposed to know. A bail-in only works if depositors don't see it coming. If everyone withdraws their money before the announcement, the bank collapses faster. The whole point of closing banks on a Friday night and freezing accounts is to trap the money inside before anyone can escape. The informed escape, the uninformed pay. Elena Georgiou was 31 when the Cyprus bail-in happened. She worked as a compliance officer at one of the affected banks. She knew the legal framework. She knew bail-ins were possible under EU law. And she told no one, not her parents, not her friends, not the small business owners who banked with her institution. "I couldn't," she said in an interview years later. Her voice was flat, almost mechanical. It would have been illegal. It would have been insider information. I would have gone to prison. So she said nothing. And she watched her parents lose $95,000. That's the system working as designed. The people inside know. The people outside don't. And by the time you hear about it on the news, your money is already gone. In 2026, there are 186 regional banks in the United States over-leveraged on commercial real estate loans. $1.5 trillion in those loans mature this year and next. Property values are down 40%. Interest rates have tripled. The borrowers can't refinance. The question isn't whether some of these banks will fail. The question is how many and whether the FDIC fund can cover the losses. And if it can't, if the math doesn't work, there's a legal mechanism already in place to make up the difference. That mechanism is your money. To understand why your deposits can legally become bank stock, you need to understand a single event, September 2008. Lehman Brothers collapsed. The financial system froze. Banks stopped lending to each other. The entire global economy came within hours of complete cardiac arrest. The U.S. government responded with a $700 billion bailout TARP, the Troubled Asset Relief Program. Taxpayer money used to rescue the same Wall Street institutions whose reckless bets had caused the crisis. The public reaction was volcanic. Thomas Garrett was 53 years old in October 2008. A machinist in Toledo, Ohio. He still remembers standing in his union hall watching the news as Congress debated the bailout. The men around him were silent. Some had tears in their eyes. Not from sadness, from rage. They were losing their jobs. Their pensions were evaporating. And the government was about to hand $700 billion to the bankers who destroyed their lives. "We bailed them out," Thomas said years later. "We lost everything, and we bailed them out." That anger didn't fade. It metastasized. Politicians received death threats. Protests erupted across the country. The phrase, "too big to fail," became a curse word. And behind closed doors, government officials realized something critical: they could never do another bailout like that. The public wouldn't tolerate it. The political cost was too high. But here's the problem. Banks still fail. Financial crises still happen. And when a major bank collapses, someone has to pay for the losses. If taxpayers won't pay, who does? The answer came in 2010, buried in 848 pages of financial reform legislation. The Dodd-Frank Wall Street Reform and Consumer Protection Act. Title II of that act created something called Orderly Liquidation Authority. Read that phrase carefully. It sounds bureaucratic, boring, technical. That's intentional. Because what Orderly Liquidation Authority actually means is this. When a large financial institution fails, the FDIC can step in, seize the bank, and convert certain liabilities into equity to absorb losses. Liabilities means money the bank owes, and the largest liability most banks have is deposits. Your deposits. Think of it this way. Imagine you loan your neighbor $1,000. He promises to pay you back. That $1,000 is now his liability he owes you. But what if he can't pay? What if he's broke? Under normal rules, you'd take him to court, force him to sell his assets, try to recover what you can. But under bail-in rules, something different happens. The court says, your neighbor can't pay you back in cash. Instead, you now own 10% of his house. Congratulations, you're an equity holder. Sounds almost reasonable, right? Except his house is on fire, and you can't sell your share until the fire is out. And by the time the fire is out, the house is worth 20% of what it was. That's a bail-in. Your cash becomes equity in a failing institution, and by the time you can do anything with that equity, it's nearly worthless. What most people get wrong about Dodd-Frank is its intent. They assume the law was written to protect consumers. It wasn't. It was written to protect the financial system, and more specifically to protect the government from having to use taxpayer money in the next crisis. The law explicitly creates a mechanism where losses are absorbed by creditors, including depositors, instead of taxpayers. This isn't hidden, it's in the text. Section 210 of Dodd-Frank authorizes the FDIC to treat similarly situated creditors differently during a resolution if it determines that such treatment is necessary to maximize the value of the assets or minimize the amount of any loss. Translation: the FDIC can decide which depositors get paid and which depositors get converted to equity. They have legal discretion to treat you differently than someone else with the same claim. Now let me ask you a question. If this authority has existed since 2010, why haven't we seen it used in the United States? The answer is timing. We haven't had the right kind of crisis yet. Remember Nikos Anastasiou from Part 1, the retired accountant who lost 85% of his savings in Cyprus. His bank didn't fail because of fraud or mismanagement. It failed because of overexposure to Greek government bonds. When Greece defaulted, Cypriot banks holding those bonds became insolvent overnight. The mechanism was straightforward. Bad assets created losses. Losses exceeded the bank's capital. The bank couldn't pay its obligations. Something had to give. In Cyprus, that something was depositors. Jennifer Walsh was 38 in 2010, a regulatory attorney at the FDIC. She worked on the team that drafted the Orderly Liquidation Authority provisions. In a rare interview years later, she described the internal discussions with clinical precision. The question was never whether bail-in authority was fair to depositors. The question was whether it was legally defensible and operationally feasible. We studied Cyprus before Cyprus happened. We studied Iceland. We knew the framework would work because we'd seen it work elsewhere. Hold that phrase. They knew it would work because they'd seen it work elsewhere. The legal architecture wasn't created in response to Cyprus. Cyprus happened in 2013. Dodd-Frank passed in 2010. The American bail-in framework was built first. Europe copied it. Cyprus implemented it. The United States watched, took notes, and refined their procedures. Here's the micro hook you need to hold on to. The FDIC has conducted simulation exercises for bail-in scenarios. They have playbooks. They have procedures. They have decision trees for exactly how to convert deposits to equity, which depositors to prioritize, how to communicate with the public, how to manage the inevitable panic. This isn't theoretical. It's operational. Now let's talk about the trigger mechanism, the specific condition that would activate bail-in authority. Marcus Thompson spent 22 years as a bank examiner for the Office of the Comptroller of the Currency. He retired in 2019. When I asked him what would trigger a bail-in scenario in the United States, his answer was immediate. Commercial real estate concentration. That's the bomb sitting in regional bank balance sheets. Everyone knows it. The regulators know it. The banks know it. We're all just waiting to see who goes first. Here's the math. Regional banks institutions with $10 billion to $250 billion in assets hold approximately 70% of all commercial real estate loans in the United States. These loans were issued in 2019, 2020, 2021, when property values were high and interest rates were near zero. Now property values are down 30 to 40%. Interest rates have tripled. And $1.5 trillion of these loans mature in 2026 and 2027, meaning borrowers must either pay them off or refinance at current rates. Most can't refinance. The numbers don't work. A building worth $100 million in 2021 might be worth $65 million today. The loan was for $75 million. The borrower is underwater. They default. If you visualize the regional banking sector as a table with 186 glasses of water each filled to different levels, the commercial real estate loans are weights being placed on the table. 1 glass tips over, that's manageable. 10 glasses concerning. But what happens when 50 glasses tip simultaneously? The FDIC fund holds $128 billion. If losses exceed that, the mechanism shifts from insurance to resolution, from payout to bail-in. And here's the contrarian point that most analysts miss. The FDIC doesn't have to wait until the fund is empty. Under Dodd-Frank, they can implement bail-in procedures for any institution they designate as systemically important, or whose failure would have serious adverse effects on financial stability. They can choose to bail in your deposits before trying insurance if they determine that approach better serves financial stability. The rules were designed to protect the system, not you. Marcus Thompson keeps a framed quote on his desk from his first supervisor at the OCC, something the man told him in 1997. Banks don't fail on Mondays, they fail on Fridays. That gives regulators the weekend to clean up the mess before anyone notices. It's now Thursday, and 186 regional banks are sitting on loans that mature in the next 18 months. The question is not whether the mechanism will be used. The question is how it works when it's activated step by step, hour by hour, from the moment the FDIC picks up the phone on Friday night to the moment you discover your deposits have become worthless stock on Monday morning. Let me walk you through exactly how you lose your money, step by step, hour by hour. It's Friday afternoon. You're at work finishing up for the week. Your regional bank, let's call it Heartland Community Bank, has been in the news lately. Something about commercial real estate losses. Stock down 40%. But you're not worried. You have FDIC insurance. Your money is safe. At 4:47 p.m. Eastern Time, the FDIC receives a call from the Office of the Comptroller of the Currency. Heartland's liquidity position has deteriorated below regulatory minimums. The bank cannot meet Monday's obligations. It's over. By 6:15 p.m., an FDIC resolution team is on a plane. By 8:00 p.m., they're in Heartland's headquarters, escorted by federal marshals. The CEO is informed that the FDIC is taking control of the institution, effective immediately. You're at dinner with your family. You don't know any of this. By 10:00 p.m., the FDIC has completed a preliminary review of Heartland's balance sheet. Total deposits, $42 billion. Insured deposits, $28 billion. Uninsured deposits accounts over $250,000, $14 billion. The FDIC fund can cover the insured deposits, but just barely. There's no appetite to drain the fund for one regional bank when 40 more might fail in the next 6 months. The decision is made. Bail-in. Saturday morning you wake up to a text alert from your bank. Important notice regarding your account. Please visit our website for details. You try to log in. The website is down. You try calling. Busy signal. You drive to your local branch. There's a printed sign on the door. This institution is now under FDIC receivership. All branches will remain closed until further notice. Your stomach drops. But you still think you're protected. What most people get wrong about the bail-in process is the sequence. They assume the FDIC first pays out all insured deposits, then figures out what to do with the rest. That's not how it works. Under orderly liquidation authority, the FDIC has discretion to structure the resolution. However they determine serves financial stability. In practice, this means they can convert uninsured deposits to equity before touching the insurance fund if doing so reduces systemic risk. Sunday, the FDIC announces the resolution plan. Insured depositors will have access to their funds Monday morning. Uninsured depositors, anyone with more than $250,000, will receive shares in a newly created bridge bank entity. The shares represent your claim on the bank's assets. That's when you learn the real number. Richard Castillo still remembers the exact moment he saw his balance. He was 56 years old, owned a plumbing supply company in Phoenix, and had $620,000 in his business account at a regional bank that failed in the spring of 2023, not in a bail-in, but in a traditional failure where the FDIC did cover most uninsured deposits. He was lucky. I stared at the screen for 10 minutes, he told me. I had $620,000 on Friday. On Monday, I could access $250,000. The rest was pending resolution. I couldn't make payroll. I had 16 employees. I had to tell them I didn't know if I could pay them. Richard eventually recovered most of his money, about 85 cents on the dollar, because his bank was acquired by a larger institution that assumed the deposits. But in a bail-in scenario, there is no acquisition. There is no 85 cents on the dollar. There is equity in a failing bank. Now let me ask you a question that should keep you awake tonight. If your bank fails on a Friday and implements a bail-in on Sunday, how do you access your money on Monday? The answer is the insured portion goes through. The uninsured portion is frozen until the equity is valued, which can take weeks or months. And when that equity is finally valued, if you visualize the chart showing the typical trajectory of bail-in equity, the line drops like a stone off a cliff. In Cyprus, depositors received shares worth 47.5% of their uninsured deposits on paper. Within 6 months, those shares had lost another 70% of their paper value. The actual recovery rate for Cypriot uninsured depositors was somewhere between 10 and 20 cents on the dollar. Here's the first twist that should infuriate you. The Friday before the Cyprus bail-in was announced, $4.5 billion was withdrawn from Cypriot banks. 4.5 billion euros in one day. Regular depositors like Nikos Anastasiou, the retired accountant from Part 1, who lost 85% of his savings, couldn't withdraw. The banks were officially open, but the systems were experiencing technical difficulties. ATMs had maintenance issues. Wire transfers were delayed for processing. But somehow, $4.5 billion found its way out. Investigations later revealed that politically connected depositors, wealthy foreign nationals, and certain corporate accounts had received advance warning. Not official warning. Whispered warning. Phone calls from bankers who owed favors. Texts from friends in government. The kind of information that flows through private channels while regular people wait in line at ATMs that don't work. The people who knew got out. The people who trusted the system got bailed in. Pause for a moment and consider what this means for you. Catherine Webb was 44 in March 2013, an American expatriate running a marketing consultancy in Limassol, Cyprus. She had $340,000 in a Cypriot bank, her business operating account plus personal savings accumulated over 12 years abroad. On the Thursday before the bail-in, she noticed something strange. My Cypriot business partner made an excuse to leave our meeting early, she recalled. Very unusual for him. I found out later he went straight to the bank and withdrew $180,000 in cash. He knew. Someone told him. Catherine's partner kept his money. Catherine lost $67,000 after the bail-in and equity collapse. Same bank, same week, different information. This is the rage moment. This is the part that should make your blood boil. The bail-in mechanism isn't just a technical procedure for resolving bank failures. It's a wealth transfer system with a built-in escape hatch for insiders. The people who design the rules know how to avoid them. The people who enforce the rules warn their friends. And the people who follow the rules, who trust the system, who believe in FDIC insurance, who keep their money in the bank like responsible citizens, they're the ones who pay. Remember Thomas Garrett from Part 2. The Toledo machinist who stood in his union hall watching the 2008 bailout with tears of rage. He was angry because taxpayers were rescuing bankers. But at least in a bailout, the losses are spread across the entire tax base. Everyone pays a little. In a bail-in, the losses are concentrated entirely on depositors of the failing bank. You pay everything. The taxpayer next door with money in a different bank pays nothing. Here's the second twist. The FDIC has already decided which banks are candidates for bail-in resolution versus traditional insurance payout. They have a list. It's not public, but it exists. Banks are categorized by systemic importance, interconnectedness, and resolution complexity. If your bank is on that list, your deposits above $250,000 are not insured in any meaningful sense. They're pre-positioned for conversion. Daniel Reeves spent 18 years at the FDIC before moving to private consulting in 2021. He won't confirm the existence of the list directly, but when I asked him how the agency prioritizes resolution strategies, his answer was carefully worded. The FDIC conducts ongoing assessments of resolution options for all institutions above a certain asset threshold. Those assessments include modeling for various scenarios, including scenarios where traditional insurance payout might not be the optimal approach. Translation, they've already done the math on your bank. Now here's the micro hook that makes this personal. You can actually check your bank's vulnerability. Every bank files quarterly reports showing their commercial real estate exposure as a percentage of total capital. If that number exceeds 300%, your bank is in the danger zone. If it exceeds 500%, your bank is a bail-in candidate. The information is public. It's just not publicized. Linda Okafor was 39, a dentist in suburban Atlanta, when she first heard about commercial real estate concentration ratios. That was 3 months ago. She looked up her bank, a regional institution with 15 branches across Georgia. The ratio was 487%. I felt sick, she said. I had $380,000 in that account. My entire practice's operating capital. I moved it the next week, split it across 4 different banks, each under $250,000. Linda got out. Most people won't. Remember Marcus Thompson from Part 2. The retired bank examiner who said commercial real estate concentration was the bomb sitting in regional bank balance sheets. He told me something else in our conversation, something that crystallizes the timeline. The maturity wall hits hardest in Q2 and Q3 of 2026. That's when the largest concentration of commercial real estate loans come due. If borrowers can't refinance, and most can't at current rates, defaults spike. If defaults spike, bank losses spike. If losses exceed capital buffers, you're in resolution territory. We are now in 2026. Q2 begins in April. The infrastructure is built. The legal authority exists. The trigger is loaded. The only question remaining is who gets destroyed when the trap closes and whether you'll be among them. Because the truly devastating part of a bail-in isn't just losing your money. It's what happens next. It's the cascade. It's the contagion. It's watching your neighbor run to their bank because they saw what happened to yours. And it's understanding too late that once the first domino falls, there's no stopping the rest. The bail-in doesn't end on Monday morning. That's when it begins. What comes next is slower, quieter, and in many ways more devastating than the initial confiscation. Because a bail-in doesn't just take your money, it takes your future. It takes the business you were going to expand, the house you were going to buy, the retirement you were going to have. And it does this not in a single dramatic moment, but through years of compounding consequences that most people never see coming. Let me show you what the next decade looks like. George Demetriou was 51 years old when the Cyprus bail-in hit in 2013. He owned a small chain of pharmacies in Nicosia, 3 locations, 12 employees, $420,000 in his business account for inventory, payroll, and expansion capital. After the bail-in, he had $250,000 in accessible cash and $170,000 in worthless equity. Within 6 months, George had to close 1 pharmacy. He couldn't afford inventory for 3 locations. Within 18 months, he closed the second. By 2015, he was down to 1 store, 4 employees, and a debt load he'd taken on trying to keep the business alive. If you visualize George's net worth on a timeline from 2013 to 2023, the line doesn't crash and recover. It crashes and keeps declining. In 2013, his net worth was approximately $1.2 million. The pharmacy's his home, his savings. By 2023, his net worth was $340,000. He's 61 now, working 6 days a week at his single remaining pharmacy, with no realistic prospect of retirement before 75. "I did everything right," he told an interviewer last year. His voice was flat, exhausted. "I saved, I built a business, I employed people, and they took it, not criminals, the government." Now contrast George with someone who understood the system. Alexandros Mavros was 44 in 2013, a shipping logistics executive based in Limassol. Unlike George, Alexandros had diversified his holdings years earlier, not because he predicted the bail-in specifically, but because he'd grown up watching his father lose money in the 1974 Turkish invasion and learned never to keep all his wealth in one country or one asset class. When the bail-in hit, Alexandros lost $85,000, painful but not catastrophic. His remaining wealth was spread across Swiss bank accounts, London real estate, and a Singapore-based holding company. Over the next decade, while George's trajectory went down, Alexandros's went up. He bought distressed Cypriot commercial property at 35 cents on the dollar. He acquired a struggling competitor's shipping contracts at a discount. By 2023, his net worth had increased by approximately 60%. Same crisis. Same country. Same week. One man was destroyed. One man got richer. The difference was not intelligence or hard work. George worked harder than anyone I've interviewed for this video. The difference was structural, where the money sat when the trap closed. Here's what most people get wrong about bail-in recovery. They assume it's temporary. They think, okay, I lose 50% or 60%, but I'll rebuild. I'll earn it back. Life goes on. But the math doesn't work that way. If you lose 60% of your capital, you don't need a 60% gain to recover. You need a 150% gain. If you had $500,000 and lost 60%, you now have $200,000. To get back to $500,000, you need to grow $200,000 by 150%. That takes most people 15 to 20 years, if they can do it at all. And during those 15 to 20 years, life doesn't pause. Your kids still need college tuition. Medical emergencies still happen. Cars break down, roofs leak. You're not just trying to rebuild, you're trying to rebuild while the normal expenses of life keep draining whatever you have left. Maria Santos, the restaurant owner from Part 1, who lost $80,000 and had to close her business, never reopened. She's 55 now. She works as a manager at a restaurant owned by someone else. Her salary is $2,100 per month. She'll work until she's at least 70. Sometimes I drive past my old location, she said. There's a different restaurant there now, Turkish food. They're doing well. She paused for a long time after saying that. Let me ask you a question that should clarify the stakes. If you lost 60% of your liquid assets this year, what would you have to cancel? What would you have to give up? Which dreams would die? The answer to that question is what a bail-in actually costs. Now let's look at the systemic picture. What happens when bail-ins don't strike one bank but dozens simultaneously? Iceland provides the closest parallel. In 2008, all three of Iceland's major banks collapsed within a single week. The government didn't bail them out, couldn't bail them out. The bank's liabilities exceeded Iceland's entire GDP by a factor of 10. Instead, Iceland implemented what was effectively a national bail-in, though they used different legal mechanisms. Foreign depositors lost approximately 90% of their holdings. Domestic depositors were partially protected, but the Icelandic krona collapsed by 50% against major currencies, effectively cutting everyone's purchasing power in half. Inflation spiked to 18%. Interest rates hit 15%. If you visualize Iceland's GDP per capita from 2007 to 2015, the chart shows a sharp drop, followed by a slow grinding recovery that took 7 years to return to pre-crisis levels. 7 years. An entire generation of Icelanders entered adulthood during an economic depression caused by banking failures. The United States is not Iceland. The scale is different. The dollar's reserve currency status provides buffers that the krona never had. But the mechanism is identical. When bank losses exceed the system's capacity to absorb them through insurance, someone else pays. And that someone is always depositors. Here's the first twist that most analysts miss. In a wave of bail-ins, the second and third failures are worse than the first. When the first bank fails and depositors lose money, everyone at similar banks panics. They try to withdraw their funds. But you can't move $400,000 in a day. Wire transfers take time. Withdrawal limits apply. Banks can impose gates restricting outflows during periods of stress. So you're trapped. You watch the first bail-in on the news. You try to move your money. The system slows you down. And by the time your transfer clears, your bank has already been seized. Raymond Chen was 47 when Silicon Valley Bank collapsed in March 2023. He had $2.3 million in a business account, operating capital for his semiconductor components company. He watched the news on Thursday night. He initiated a wire transfer Friday morning. The bank was seized Friday afternoon before his transfer processed. Raymond eventually recovered his money because the FDIC made an exception for SVB and covered all deposits insured and uninsured. But he still remembers those 72 hours. I didn't sleep. I didn't eat. I thought I'd lost everything. My employees' jobs, my suppliers' payments, 10 years of work gone because I didn't move fast enough. Raymond got lucky. The next wave of depositors won't be. Here's the second twist, and this one is darker. The people who benefit most from bail-ins are the same people who benefit most from every financial crisis, those with liquid capital ready to deploy when prices collapse. Remember Alexandros Mavros, the shipping executive who bought distressed Cypriot property at 35 cents on the dollar. He wasn't alone. In the 18 months following the Cyprus bail-in, foreign investment funds, mostly from Russia, Israel, and the UK, purchased approximately $2.8 billion in Cypriot real estate and business assets. They didn't cause the crisis, but they were ready for it. They had capital positioned outside the system waiting to buy when everyone else was forced to sell. The bail-in didn't destroy wealth. It transferred wealth from middle-class depositors who trusted the banking system to sophisticated investors who didn't. Remember Catherine Webb from Part 3. The American consultant who lost $67,000. while her Cypriot business partner escaped with his savings intact. 10 years later, her partner owns the building where she used to rent office space. He bought it in 2014 when prices were at their lowest. She pays him rent now. This is the architecture of the system working exactly as designed. Crises concentrate wealth. They move assets from weak hands to strong hands, from the uninformed to the informed, from those who trust institutions to those who understand them. And the institution that enables this transfer, the bail-in mechanism, was written into law by the same financial system that benefits from it. The question isn't whether this is fair. It's not. The question is whether you'll be on the giving end or the receiving end when the next transfer occurs. Because the trigger is already loaded, the timeline is already set, and the only variable left is whether you'll be George Demetriou, watching your life's work evaporate over a decade of slow-motion collapse, or Alexandros Mavros, positioned to survive and even profit while others lose everything. The difference is decided now, in the next 90 days, before the maturity wall hits. Let's return to where we started. Nikos Anastasiou, 68 years old, sitting in his Nicosia apartment on a Saturday morning in March 2013, watching the news anchor announce that his life savings had just been confiscated. His wife's face going pale, the newspaper falling from his hands. I spoke with Nikos last year. He's 79 now. He lives in a smaller apartment, sold the original one in 2016 to cover medical expenses. His wife passed away in 2019. He gets by on a government pension and occasional help from his daughter, who moved to Germany in 2014 because there were no jobs left in Cyprus for young people. I trusted the system, he told me. His voice was quiet, not angry anymore. Just tired. I worked 43 years. I paid my taxes. I followed the rules. And they took everything. Not because I did something wrong, because I was there. Because my money was there. He paused for a long time. The banks are still open. The politicians are still in office. Nothing changed for them. Everything changed for me. That's the pattern. That's what we've traced across 5 parts of this video. The system protects itself. The losses flow downward. And the people who design the rules are never the ones who pay when the rules are applied. Now let me show you what's happening right now in 2026 as you watch this video. If you visualize the commercial real estate loan maturity schedule as a wall, a physical wall of debt coming due, you would see it rising sharply starting this quarter. $450 billion in Q2, $380 billion in Q3, $340 billion in Q4, nearly $1.2 trillion in total by year-end, with another $300 billion in early 2027. These loans were made when office buildings were full and interest rates were near zero. Now offices are 30–40% vacant in most major cities. Interest rates have tripled. Property values have collapsed. The borrowers cannot refinance. They will default. The defaults are already starting. They're just not making headlines yet. Marcus Thompson, the retired bank examiner from Part 2, who called commercial real estate concentration the bomb in regional bank balance sheets, sent me an email 2 weeks ago. He'd been tracking call reports from the 186 banks on his watch list. 12 banks have crossed the 500% CRE concentration threshold since January, he wrote. That's the red zone. That's where failures become probable rather than possible. This is happening faster than I expected. Let me ask you a question. If you have more than $250,000 in any single bank right now, do you know your bank's commercial real estate exposure ratio? The information is public. It's filed quarterly with the FDIC. You can look it up in 15 minutes. But most people won't. Most people assume someone else is watching out for them. Most people trust the system. Nikos trusted the system. Here's the contrarian point that cuts against the fear. I am not telling you a crisis will definitely happen. No one can predict timing with certainty. The commercial real estate maturity wall might be extended. Regulators might intervene. Interest rates might fall. The losses might be absorbed gradually rather than catastrophically. What I am telling you is that the mechanism exists. The legal authority is in place. The precedent has been set. And if the math doesn't work, if losses exceed the FDIC's capacity to absorb them, there is a pre-built system for converting your deposits into worthless equity. The question is whether you want to find out after the fact that you were exposed. Linda Okafor, the Atlanta dentist from Part 3, who discovered her bank had a 487% CRE concentration ratio and moved her money within a week, didn't wait to find out. She now has her operating capital spread across 4 institutions, each under $250,000. She sleeps better. It took me 3 days to set up the new accounts, she said. 3 days of paperwork versus potentially losing $130,000. That math wasn't hard. The math isn't hard. The psychology is hard. Admitting that the system you've trusted your entire life might not protect you. That's the difficult part. Remember Elena Georgiou from Part 1. The Cypriot bank compliance officer who knew the bail-in was coming but couldn't warn anyone, not even her parents, because it would have been illegal. She left banking entirely after 2013. She teaches high school economics now. And every semester she gives her students the same lecture. I tell them, learn how the system actually works. Not how they say it works, how it actually works. Because nobody will protect you except you. That's not financial advice. That's survival advice. Let me give you a framework. Not investment recommendations, just questions worth asking yourself. First, what percentage of your liquid assets are held in accounts above the $250,000 FDIC insurance limit? If the answer is more than 0, you are exposed to bail-in risk by definition. Second, do you know your bank's commercial real estate concentration ratio? If the answer is no, you're trusting an institution you haven't evaluated. Third, if you read in the news tomorrow that a regional bank in another state had implemented a bail-in and depositors lost 60%, what would you do? Would you have time to move your money before contagion spread to your bank? Or would you be George Demetriou, watching helplessly as the system closes around you? These aren't rhetorical questions. They have answers. And the answers should inform what you do in the next 90 days. Here's the twist that should reframe everything you've heard in this video. The bail-in mechanism wasn't created to hurt you. It was created to protect the system from something worse: complete financial collapse, taxpayer-funded bailouts that bankrupt governments, cascading failures that destroy the entire economy. The people who designed it weren't villains. They were technocrats solving a technical problem. How do you resolve a failing bank without using public money? Their solution works. It stabilizes the system. It prevents contagion. It protects taxpayers. It just does all of this by sacrificing depositors. That's not a conspiracy. That's a policy choice. A choice that was made for you without your input by people who will never be affected by it. And now, that choice sits in the U.S. legal code waiting to be activated. Richard Castillo, the Phoenix plumbing supply owner from Part 3, who almost lost $620,000 when his bank failed, restructured his business accounts after that experience. It took him 2 months. It required conversations with accountants and lawyers. It was, in his words, the most annoying financial project of my life. But now his maximum exposure at any single institution is $240,000. If I'd known before, he said, I would have done it years ago. Nobody tells you this stuff. You have to learn it the hard way or the lucky way. I was lucky. Most people won't be. The pattern we've traced in this video is not new. It's not unique to Cyprus or Iceland or the United States. It's the pattern of every financial system in history. The rules protect the system. The losses flow to those who trusted it, and the informed escape while the uninformed pay. I started this video by telling you there's a law on the books that allows the government to take your deposits and turn them into worthless stock. That law is real. The authority is real. The trigger conditions are materializing right now in real time in 186 regional banks across America. I cannot tell you when or if the mechanism will be used. But I can tell you this. The people who designed it know exactly how it works. The wealthy have already positioned themselves outside its reach, and the only people who will be surprised when it activates are the people who never learned it existed. You are no longer one of those people. The question is what you do with that knowledge while there's still time to act on it. The FDIC doesn't protect your deposits. It protects the system. Your deposits are just the price of admission.